Okay, everybody, it is me, it's you, and I love this part, and I'm in kind of a giddy mood because it's just too freaking insane. You gotta laugh, I assume. Okay, let's talk. So, yes, September 19th, 2022, people, post-market wrap-up. Lovely, fantastic. A nearly 500-point swing in the Dow Jones Industrial Average. Stocks started down across the board. Dollar stronger, 10-year yield around 3.5. Pan sell-off. Everything was under pressure. Okay, just freaking lovely here. And just by some miracle, things turn around. But here's the situation. Why did the market turn around like this? It's multifactorial, but it's the continuing round after round after round of bad economic news, which even, continues through till today. Now, bad economic news is positive for an upside down twisted market. Why? The bad economic news is kind of sending like a signal to the stock market that the Fed is not going to be as aggressive here, raising the dog shit federal funds rate. The market's kind of really fixated on this right now. I don't understand why. It's not working. It's not doing anything. We continue to see inflation surge out of control. Here's some of the Here's some of the bad economic news that we got. I'm laughing, but it's just pathetic. U.S. home builder sentiment now has fallen for 9 consecutive months. Home builders are being forced to lower prices. The money velocity, you know what this is, people, the rate at which cash is moving through an economy. And I'm going to cover that real quick before I move on. Now, does it make sense to you that if an economy was really strong and really booming, you would have money velocity at near a historic low, or should it be moving higher? Duh. Yeah. In a booming economy situation, the rate at which cash is moving through the economy should be moving higher, not lower. Well, we're going lower. But remember, we're not in recession. We're not in recession because Yellen says no. And our president, who really cannot walk and chew gum at the same time, he says we're not either. And they must be, right? Because no one would lie to you, especially the Federal Reserve, where they're saying the same damn thing. Can't make it up, but it's impossible to do. So yes. So right off the bat, home builder sentiment cratering for 9 months. Money velocity near a historic low. Now, this is where it gets kind of sad in my view here. More people globally are taking on more debt. Okay, this is a phenomenon that you and I have discussed here in this blog. I don't even know how long ago that this would happen. It's getting progressively worse. As a matter of fact, in July, consumer debt hit yet an all-time high, a new all-time record high, and that's not going to stop. People are continuing to borrow beyond their ability to pay back, and loan defaults are taking off, mortgage defaults, and people are now, they're getting involved in a very dangerous game, these adjustable rate mortgages. It sounds very familiar to me. It should to you. This is literally part of the situation that took down the global economy in the last meltdown. But it's okay now. Now it's okay. And they're offering 10-year car loans now. Really? How does that work? Fantastic. Look, none of this stuff is actually meant to be paid back. Mortgages, people are just meant to be slaves to it for their entire lives. And, car loans that go on, and they just don't stop. So anyway, the number of people now carrying a higher debt load today is 50% higher than it was year over year. Now that trend is going to get worse and accelerate here. And the phenomenon is very simple. People are trying to claw themselves higher. They don't want to maintain that illusion, people. It's, life in many ways is an illusion. You go look at your neighbor's house, really beautiful, nice cars sitting outside there, but they won't tell you how much in debt they are. Okay, this is their illusion here. They got their kids dressed up in designer clothes, and the dog is wearing a designer collar. It's just crazy. But this is what people are doing. They're burying themselves. It's a terrible phenomenon to see, but that is the case. Anyway, so a wild ride here in the stock market. Now, as I said, a few things were driving this. I don't want to say a normalization, because it's certainly not, but a stabilization in that 10-year yield. It did not rise today. It's stayed relatively flat. Last time I looked at it, 3.48. This morning it was 3.5. The dollar reversing and dropping, okay, that obviously is positive here for stocks here. And of course, the continuing round of bad economic news. So look, the market believes, and I've been saying this for a while, and most of you agree, that the Fed and central banks are going to do more. Maybe we're all deluded, including the stock market, which is the collective consciousness of all its participants. Maybe we're all just out there and the Fed is going to let this thing melt down. I just don't think so. As I've been telling you over and over again, I don't think they're done inflating. I don't think they're done buying assets with their product debt that they just create out of thin air. They haven't finished finalizing what will eventually be their final solution, and that is to allow the implosion of the debt market, wipe out the stock market here, create a resource problem on a global scale. People will be in the streets. That's when people are going to take to the streets, when they realize that this entire thing has been nothing but an illusion, and that's really what it is here. All right, let's move on. So cryptocurrencies, okay, under some pressure. Gold and silver were under more pressure earlier, but did turn around as the dollar got weaker. You know how this works. Commodities priced in dollars. I want to touch on something real quick, but hold that thought. Crude oil, about flat. That's where we stand. Now, a lot of people are asking, okay, Greg, is the dollar eventually going to break? Is it going to crack? What's going to happen to the dollar here? Eventually, I think it's going to, absolutely here. And there are several factors here that could play into that. Expanding wars at first, I think, would be a knee-jerk higher in the dollar. Some kind of an economic shock would also cause a knee-jerk higher, but then this would reverse, depending on how it plays out here. Now, look, when we're talking about dollar strength, don't make a mistake. We're talking about its relative strength. As much as I cover relative strength versus absolute strength or its purchasing power, people get very confused. Relative strength, people, is so simple to understand. It's just comparing the dollar to other currencies. So it's relative value compared to other currencies. Its absolute value is purchasing power, which continues to crater. You understand? I know some of these concepts are a little bit out there, like Greg Mannarino is, but they're not really that hard to understand if you just think about it for a moment. So look, that's where we stand today. Look, it's very possible that we could continue to see global bond yields rise, bonds selling off globally, which is a big issue with liquidity. I've covered this to the point of nauseum. And that is going to get out of control at one point. I'm not a permeable, okay? I'm just looking at the situation, and I just don't think so right now. And again, I could be way off. And I want to hear from you. More and more of you seem to agree with me that the central banks aren't done. And, they're going to continue to rig the debt market. That's what all this is. This whole market, everything is, what have I said? It's a house of cards built over a pool of gasoline. And it's just a matter of time before this whole thing gets very, very real for people. We're already seeing people suffer on a pretty profound scale. They continue to borrow. They can't make ends meet. It's a terrible situation to be in for people. This is definitely not just a recession, although we're not in one. That's not. Janet Yellen says no, so she must be right. But look, I think all of you are crystal clear on what's going on. And again, going back to what I always say, you know what to do about it. To me, it's very simple. If we realize at one point this is all going to change dramatically, risk on will turn risk off, cash will flood into commodities. That's my biggest takeaway from all this. And I want you to understand why. Again, we've seen this before. Markets run in cycles. We still remain in a risk on cycle mode. Okay, otherwise the market would be down much more than it is today. Is it possible things could turn around? If in fact, of course it could. If we start to see some stabilization in the debt market, 10-year yield even stays where it is. Look, I'm going to tell you again. The number or where the 10-year yield is not the actual issue. It's the pace at how fast it's rising. Okay, a rapid rise in the 10-year yield, bond yields is a big tell that things are going south fast. You understand? But let's just say, let's throw a hypothetical out here again. Let's say we're at 3.5. Let's say we're at 3.6. And all of a sudden we settle there. The stock market with its googly eyeballs are going to sit there, look at that 10-year and say, hold on a minute. Okay, we're seeing it. It's stable. We're not supposed to see these gyrations here in the debt market, people. You're not supposed to see this. Okay, it's clearly a sign of instability. So if the stock market participants, investors, whatever, see that 10-year yield stabilize at a certain point here, and if we get some dollar weakness, the market's going higher. If the opposite happens, well, then the market's going lower and much lower. And if we get a rapid, uncontrolled sell-off, say goodbye. Say goodbye to the value of your stock portfolio. I think this is extremely easy to understand. I really do. It's kind of like, cause effect, cause effect. Anyway, I want to hear from you. I want to hear what you think about all this lovely stuff we just covered. Please share the video. I will see all of you in the morning. Looking forward to it. And I'm just out of here.